This is called, Has the Car Market Ruined Itself?
Year so far, but none are feeling the pain quite as much as car manufacturers. Of course, Tesla has been getting most of the attention as its stock price has plummeted by more than 50% since its peak late last year. Sales across the world have plummeted, as the brand has become an unintentional political statement. A political statement that doesn't really vibe with the type of people that buy electric cars. But the truth is that most other car companies are happy to let Tesla soak up the headlines, because under the proverbial hood, they have a lot of problems of their own. Major brand bankruptcies are now basically inevitable. Will they, won't they trade wars are crippling supply chains, new manufacturers from China are undercutting global markets, and worst of all, people just simply can't afford to buy cars right now. And in response to this simple financial reality, automakers have responded by making their cars more expensive than ever before.
It's told Honda it wants to call off merger talks. That's according to a Reuters source on Thursday.
Honda, Mitsubishi, and Nissan had been in talks to form a joint holding company, but ultimately they could not agree on terms.
For buyers with limited income or credit scores, Jessica Caldwell of Edmond says more Americans are opting for longer repayment plans.
And finally, though, for folks who are really struggling, I always say this one, pick up the phone, call your lender, let them know the truth. You're struggling and you need help.
So the simple reality for most people in America is they can't responsibly afford to own a car, but they also can't afford not to own a car. The Federal Aid Highway Act of 1956 built out the American interstate system and decidedly made most cities extremely car-centric. These new highways connected cities, and lobbying from automobile manufacturers pushed local public transport out of the way in favor of car-friendly streets. The adoption of the car also let mostly middle-class white Americans move out of cities and into newly developed single-family suburbs built around independent transportation. According to data from the US Census and the American Public Transport Association, 92% of American households own a car, but only 55% have access to any form of public transportation. And even for those that do, it's not always reliable.
Yeah, I have no access to public transportation whatsoever. There's no buses, trains, or anything where I live. Not even within like 30 miles of where I live. So like owning a car is the only way you're getting around unless you Uber around.
Or practical. Now this has hurt the finances of a lot of households in truly unprecedented ways over the last 7 decades, but it has been fantastic for business. America has had the world's most valuable car market for most of the last century. To date, we have been overtaken by China, who buys roughly twice as many cars as we do, but they also have almost 5 times as many people, so it's not really fair. We also on average buy much larger and more expensive cars. Even though China buys twice as many vehicles, total market revenue is roughly the same because we spend almost twice as much on every car. A lot of our most popular models are so large that they can't even be sold into other major markets. But automakers don't mind because in the past, they have been able to make so much money from the American market that these vehicles are worth making even if they can't be sold anywhere else. Either by choice or necessity, we Americans are also far more willing to take on debt to purchase a new vehicle, often rolling equity from one vehicle into a down payment for a new vehicle with a new loan. Auto loans are now at a record $1.6 trillion.
Oh, I don't know if he's going to cover this, but one of those videos I was watching the other day, the person was talking about how a lot of people who purchased in 2020 to 2022, when the insane dealer markups were happening, they were paying, $10, $20, $50,000 over sticker price, are now at the point where they are trading in their cars. And they're so upside down on those cars. They're taking out even bigger loans, right? Let's say they're $25,000 upside down on a car. They trade that in. They roll the $25,000 on top of the new car you just got. So you might be pushing $100,000 of car debt. So you're even worse off than you were with that car you just traded in. Like bigly, like huge. So yikes, that there's some real dire situations out there for people. And honestly, I think a lot of that has to go with the schooling. Why? I mean, like go way back and like understand during school, like there's probably a lot of personal finance things that they could have taught us in school. Like one is how to pay your taxes. That would be a great idea. Teach you how to trade, or not trade, but teach you financial literacy in school. And then another would be how to use debt, like buying a appreciating asset, versus how to not get screwed over in debt with credit cards and then like exorbitant car loans like this.
More than double what they were just a decade ago, back when rates were also a lot lower. So yeah, America has a dangerous obsession.
Oh, interest rates. Great point. Interest rates have doubled and tripled. And the cost of the vehicle doubling, and then the financing doubling. Like the people only care about the monthly payment. So to that end, that's great for financiers, right? Great for the Capital Ones, great for the Bank of Americas, great for TD Auto Finance, all of these different places you could get a car loan. Horrible for the people who are actually taking out the loans.
with big cars and risky personal debt. I know what you're thinking. That's not exactly groundbreaking journalism. But a unique mix of record high debt, high interest rates, collapsing secondhand values, high sticker prices, stagnating purchasing power, and uncertain economic conditions might mean that the car market has created its own reckoning. So it's time to learn how money works to find out how much further the car market can stretch itself. This week's video is sponsored by FlexiSpot. I spent hours sitting for your angle, so you can check it out using my link and essential. Today, the average car would set you back just under $50,000, which is only $9,000 shy of the average annual salary, before taxes. Buying the car is also just step one, shy of the average. Today, the average car would set you back just under $50,000, which is only $9,000 shy of the average annual.
Wow, I didn't realize that. Yeah. I'm thinking back 2016-ish. This is the last time I remember looking at this. But I remember it being somewhere like, I feel like it was something like half or a third of what the average wages were is what the average vehicle was. I could be way off, but I remember seeing some stat like a decade ago like that. This is crazy town. You spent an entire year working to pay for the car.
Annual salary, before taxes. Buying the car is also just step one. Insurance and maintenance on increasingly technical cars has also become more expensive over time. So, how can people afford to spend their entire income on a car? Well, of course, they can't. According to data from the Fed, over 80% of new vehicle purchases today were done through financing, and dealerships have recognized this as one of their primary profit centers. The average dealership today is more of a loan shop with an occasional side hustle of selling some cars, and over time, they have become increasingly creative with how they will finance a vehicle. In the bad old days, people would just save up and buy a car, and then auto loans became more popular as other costs ate into average household budgets. People still had to put money down, but it was a way to make the car buying process less of an upfront commitment. Today, dealerships will use the equity in a half paid off car as the down payment for the next new car as long as the entire transaction goes through them. This is or was incredibly profitable because it let dealerships make a little bit of margin from the new car sale, the used car trade-in, and the financing. But this financing treadmill has now put the whole market in a very difficult position. Used car prices spiked during the pandemic as supply chain breakdowns caused shortages. This let people trade in their old cars at higher prices to put down payments on more expensive new cars. If you were lucky and had a popular model back then, you might have been able to get more for your 3 to 5 year old car than you had spent on it when it was new. Now, the trade-off was that new cars were hard to buy and often came with dealership markups to account for market pricing. Now, this wasn't a problem back then, but it is a problem now as those cars try to repeat the cycle of rolling debt into new purchases. The average price of a used car has fallen considerably because supplies are no longer a major issue, and budget-conscious used car buyers don't have as much disposable income as they did 3 to 4 years ago with low interest rates and stimulus checks. And if things were looking bad for gas cars, it's significantly worse for EVs, but more on that soon. This means people are still underwater with the cars they have purchased with significant markups back in 2022. Some of these people can't even afford to sell their car without putting their own money down to clear their debt, let alone use the equity in their car to buy a new car. To make matters worse, car companies noticed the markups that customers were willing to pay the dealerships and wanted some of that action for themselves. When it was difficult to get enough components to keep up with demand, car companies started prioritizing higher trim variations of the same model to maximize the revenue on higher margin units. Optional extras like driver aids, sunroofs, heated and cooled seats, better sound systems, and infotainment are all sold at a significant markup from their component costs. In some cars, these components are installed anyway, and the features are just manually disabled for customers who didn't select the optional extra, so manufacturers really liked creating these higher spec vehicles. This trend quickly resulted in the market today where affordable new cars, even from previously economy-focused brands, are all but extinct, and mid-range brands are now marketing themselves as competitors in the much more lucrative luxury market. Now, this is not unique to just the car market. A lot of companies have either gone down market to focus on a growing number of cost-conscious consumers or have taken their entire brand up market. We've mentioned it before, but it's worth repeating, that the wealthiest 10% of households now account for 50% of all the spending done in the economy and are responsible for all of the economic growth. But the thing with the car market, and you are going to have to trust my math on this, but the top 10% of income earners only actually makes up 10% of the population. And even then, not all high-income households are interested in buying premium vehicles. Yes, some high-income earners have car collections, but this is still a very rare minority. As car equity dries up, interest rates have jumped, and new cars have become more expensive, it's become harder for dealerships to get deals done. Now, according to data from the Bureau of Economic Analysis, car sales have fallen, but not significantly. We are buying about 1 to 2 million fewer cars every year than we did before the pandemic. Not great, not terrible, right? Well, not exactly. All of these market conditions have combined with one unfortunate reality. Cars are just getting better. According to the S&P Global Mobility Survey, the average age of cars on the road in the US has increased by 3 years and
Well, that's interesting. Cars are getting better. I assume more reliable, unless you buy a Range Rover. So in our household, I told you this story, but I'll tell it again just for fun. I always wanted a Mini Cooper. I always wanted a Mini Cooper so bad. I remember as a kid watching Austin Powers, watching the Italian Job, and just being enthralled with Mini Coopers. And when I had the chance to buy one in 2015, I did. And I had that car for 8 years. I mean, we paid $15,000 for it. Are you kidding? It was nothing. And I loved that car so much. And I drove that car probably 100,000 miles. And one day I walk out to the car and all the fluids that were in the car were out of the car on the garage floor. And I was like, all right, well, I guess it's time for a new one. So at that point, I've been wanting a Tesla. So in 2023, I bought my Tesla new, which I was able to get a $7,500 tax credit because of that. And I was really stoked. That was great. And then my wife, she has, I think it's a 2015 Lexus GX 460, I think. Anyway, that car is bulletproof. And like, I love driving that car. It is so smooth. It is so big. It's so roomy. And like, I just know it's going to last a million miles. So I'm planning to give that to my son when he turns 16. And I'm looking at this like, bro, this is way too nice of a car for you. Are you kidding me right now? There is no world where you deserve a Lexus, even though it'll be 14 years old by the time he gets to it. No way do you deserve a fancy car like this. But when we get my wife a new car, we'd already been talking about it, right? We're looking at Range Rovers. We're looking at the Lexus LX series. And I was comparing the two, and I'm like, well, this one YouTube channel I watch called TFL. They purchased a Land Rover Defender, which the Defenders are really sweet. And they went through three of them. The first one like was mechanically ruined within like 200 miles. The second one they took in because it also had mechanical problems and they wanted to replace the engine. And they're like, no, just give us a third one. So it took a third one for them to actually get a usable car that they could do all of their testing on. So I took to my wife, I'm like, listen, as cool as Range Rovers are, I don't give that any credit. No way. So I was pointing her more towards the Lexuses again. The new GXs are cool. The LX is cool. But then again, right? The LX is $110,000. Are you kidding me? $110,000 for a car that's going to depreciate? And even the GX, while it is the Lexus version of the the Lexus Land Cruiser, or not like the Toyota Land Cruiser. There we go. Even though it's the Lexus version of the Toyota Land Cruiser, I mean, it's still $70,000 for a depreciating asset. And I'm looking at this like, what happened? What happened to these car prices? This is crazy. So for them to say that the cars are more reliable, I think that's a hit and miss, right? Good pulling that for full circle here. On the one hand, Lexuses and the Toyota lineup, I could imagine will last forever. But on the other hand, there's still a lot of cars that are not all that reliable. But I think that this graph is getting longer and higher for the life of these cars because people are saying, I can't afford a new car. I'm just going to fix the one that I'm in right now. I'm just going to fix it and we're going to keep it. Because it's a lot less, maybe even a $2,000 repair is certainly a lot less than a $70,000, $100,000 car. So yeah, this is crazy. But I think that's a lot of the reason why that these lines have gone up and up and up.
Just the last decade. It's increased by 2 years in just the past 4 years alone. This means people aren't buying new cars as often, and vehicle sales have been helped a lot by cars being sold 3 or 4 times over in their life rather than just once or twice when vehicles don't last as long. New cars might have more features on them that can go wrong, but generally the essential stuff like bodies and drivetrains are far more robust than they have ever been. And yes, I can already hear some of you typing in the comments about Nissan CVTs. There are always bad examples, but generally it's never been a better time to be a used car buyer. The average person will happily deal with some outdated electronics or broken infotainment if they have a reliable form of transportation. This has also encouraged new car buyers to seek out more reliable brands because even though they might have a warranty for the entire length of their ownership, the market perception of reliability can have a big impact on resale price. Companies like Stellantis, which makes Alfa Romeo, Dodge, Jeep, Ram, and Chrysler, have been hit by this from every direction. They played a lot of funny business with financing and dealer markups when they could, and their cars are consistently rated as some of the least reliable on the market. This is also a real problem for their ambitions to make their cars look like.
So on that topic, I watched a video not all that long ago. I watch a lot of YouTube. YouTube is my platform. I watched a video not all that long ago, and it talked about, it was a Doug DeMuro video. I'm sure a lot of y'all know Doug DeMuro. He was on Graham Stephan's Iced Coffee Hour. One day I'd love to collab with Graham Stephan. We got a lot of crossover there. But Graham was asking him about why are the ultra luxury cars, which I'd never want. Here's the deal. At one point in my life, I wanted an Aston Martin so bad. I wanted to be James Bond driving that. Now at this stage of my life, I'm like, I do not want an Aston Martin so bad. Like if you gave me an Aston or a Lambo or a Ferrari or a Bentley or a Rolls Royce, like to me, those are targets. You are asking for problems, right? You drive through the wrong neighborhood in that, you're not getting out of the neighborhood. Bro, why would anybody want that in their life? Anyway, so Graham was asking Doug DeMuro, hey, why do these ultra luxury cars, why are they so unreliable? And he's like, listen, they're not meant for the second and third owner. They're meant for the new buyer who's going to drive it for a year or two and then get another new car, take the $100,000 or whatever of depreciation and just move on. Most people can't do that. Most people are not buying a Jeep Grand Wagoneer and saying, I can't wait to trade this in 2 to 3 years, because the people who are buying this car, they're not the ones who can afford $100,000 of depreciation and then just whatever, shrug their shoulders and move on. So yeah, it's they can't price these cars in a way where middle class people who want a nicer car spend $100,000. What is a payment on that? Like $2,000 a month? Because they need to last.
Like a luxury competitor. Because when people think of Jeep, they don't think of a luxury SUV. They think of their broke cousin who bought a clapped out Wrangler off Facebook Marketplace for $2,800 in a lawnmower, as a completely random example. Now, it might almost be satisfying to see bad manufacturers who cut costs and jacked up prices to feel some consequences, but there are some bigger factors at play here that will unfortunately most likely end up hurting regular people who just need a way to get around. Most car companies are not allowed to simply fail. They employ too many people in valuable jobs, and in a lot of countries with large auto industries, they are a significant export staple. Too big to fail is not unique to the car industry, but struggling car makers are often the first sight of bad things coming, as they depend on finance, global trade, consumer confidence, labor, and resource prices to all play nice in order to run a profitable car company. We are already seeing governments step in to ease these problems. Nissan is a failing company. Their sales have slumped as their lineup has aged, and brand perception is at an all-time low thanks to a series of very public problems with critical drive.
Oh wow, I didn't know that.
Train components. The problems are also worse than the dismal sales trend alone would suggest, because a lot of volume from this brand has come from extremely aggressive financing. Even when everybody else was arguably pushing car financing too far, Nissan stood out as a brand that would write a loan on a new Maxima to basically anybody. The company also made a lot of sales to rental car fleets by offering aggressive bulk purchase discounts on their economy cars. This was a nice way to boost sales at the time, but rental car companies normally only keep their vehicles for 2 to 3 years before dumping them on the used market. This caused resale prices to tank on used Nissans because so many hit the market at the same time. Now, this wouldn't normally be Nissan's problem. However, in an effort to make sales, the company introduced a financing promotion where they would ensure the future value of their cars in certain markets around the world, so they were on the hook to buy their cars back at above value. They got away with this for a while when used car prices were high, but it's a significant hidden liability for a company already struggling.
Whoa, so they were saying that they will eat the depreciation. That's interesting. And of course, that was not a long-term plan that was going to work out.
With debt. Nissan had effectively gorged itself with short-term wins, and now it's facing complete insolvency. The Japanese government had not so subtly tried to fix these problems by playing matchmaker in a proposed merger between Honda and Nissan. The deal was promoted as a merger of equals, which would create one of the largest manufacturers in the world, but nobody took this seriously. Honda had better sales, better brand perception, they were in a better financial situation, better products, and had better management. It was a merciful way to save thousands of jobs in Japan and across the world. Now, this particular deal fell through, likely signifying the beginning of the end for Nissan, but similar interventions are likely going to become more common as other automakers deal with the same kind of problems. So yeah, dumb companies played stupid games and won stupid prizes, and unfortunately, workers are going to be the ones to feel it the worst. However, hot take alert, but we all share some blame in this as well. Cars are something that you and I, and everybody watching, are terrible at purchasing rationally. Whether we like to admit it or not, we do see the cars that we drive as a reflection of ourselves and the image we want to present to the world. Whether it's an EV to show that your RSUs got paid out, a lifted truck to show the Walmart parking lot who's boss, or a Chrysler Pacifica to show you have given up, cars are inevitably a way to communicate what we are about with total strangers. Even those people who have already left a comment talking about their 1996 Toyota Camry and how it's never going to die have still purchased an image. Their image is pretending to be better than the people who care too much about the car they are driving. Yes, car companies have become really good at taking advantage of human weakness, but we keep on falling for it. Their ads are almost always about how their cars are seen, rather than what they do, and it's all to show potential buyers how they can be seen. But as we are exposed to more advertising and social media where everybody is showing off their best life, this is resulting in some pretty alarming trends. Multiple surveys conducted on US and global car buyers found that Gen Zs, who are currently aged between 13 and 30, are the generation most likely to purchase a luxury car, despite having the lowest overall net.
Whoa, that's interesting. Younger generations don't tend to hold high net worth of older age groups, which is no surprise. Gen Z, people between 97 and 2012. My older son is born in 2012. And millennials between 81 and 96, that's me. I was born in 86. Often don't have the same amount of stock options or investment accounts for their average net worth. Median net worth, $39,000. Whoa. 35 to 44, 130. Your net worth between 35 and 44, $135,000. And you want to take a $100,000 car note. That's pretty brutal. And this is what I mean. I feel like we need to teach more financial literacy in school.
Net worth, lowest incomes, and highest proportional levels of debt. Tragically, a lot of people in this generation are realizing.
But not only that, like these people can't afford houses, right? They're never going to be able to afford a house because houses have doubled in the last handful of years. And then the financing has doubled and tripled in the last handful of years. So they're never going to afford a house. So the only status item they can have, I guess you could say, would be a nice car. But a nice car is going to depreciate in value, which doesn't make it all that nice to have in the first place.
Realizing very quickly that they may never be able to achieve financial independence or even financial stability. As a way to compensate for that, they are doing the next best thing, which is buying an expensive car to at least roleplay as people who aren't getting financially fucked from every
Which is exactly what I just said. Huh.
angle. Now, the good news is yes, car companies can use brand perception to sell us on financially irrational purchases, but those same perceptions can come back to hurt them just as fast. So yeah, we gotta talk about Tesla. From its all-time peak, the company has lost more than $500 billion in market capitalization in less than 3 months. Uncertainty around trade wars, competition in global markets from highly competitive Chinese EVs, a general consumer shift back to internal combustion engines, and broader market slowdowns have all hurt the world's most valuable automaker. But let's be honest, whether you love him or hate him, Elon Musk is inextricably linked with the company's brand image. He has gone from someone who could be the sole marketing strategy for the entire company to an individual that is pushing a lot of people who would consider buying an EV away from the brand. Now, other car companies are probably really happy he is getting all of this attention, because even though it's a lot slower, people are pushing back against the idea of owning a car at all. Walkable cities, public transport, shorter commutes, and car sharing have all become much more popular issues across America. And while we have a lot of work to undo 7 decades of car-centric planning, having no car is becoming just as fashionable as having a fancy car. 3 years ago, I made a video about why good company CEOs should not be visionary.
You want to hear a funny? Oh no! Go back!
So
you're
most
funny.
companies have not been having a, and car sharing have all as having a fancy car.
This was me a few years ago. So like I say, I used to work at Raytheon, and at that time, my wife and I were renting a house that was 4 houses away from the front gate. And this dude would be bicycling to work every day. I mean, my car didn't get used so much that I had to put a new battery in it. Like it just like straight up would die on me. So yeah, I get that. But where I live now, like this is impossible. But also working from home has changed that for a lot of people as well. So this was an interesting video. A little departure from stock news. The way that I look for things is I'm trying to find videos that are popping off right now. This one is popping off right now. And I think in general, I think the whole car industry is looking for a reckoning. I don't know when that will be. I don't know what the catalyst will be. But not just Teslas. I think a lot of manufacturers are going to be looking like we can't make any sales at all because we have priced ourselves out of our own consumers. McDonald's has this problem. McDonald's has gotten so expensive. I don't eat McDonald's. My kids and my wife do, but I'm like, no, I will not eat that. McDonald's has gotten so expensive. They have priced themselves out of the low income households that looked to places like McDonald's to be able to eat on a budget. I think that's what's going to happen with the auto industry. You tell me in the chat. You tell me in the chat if you think that's what's about to happen. Hey, real quick, let me introduce myself. I am some random guy on the internet, but my mama gave me a name, and that is Christopher Yule. I've twice been awarded top 100 people in finance. I was mentored by 5 of the market wizards, the best traders of all time. I've been successfully trading since 2009, and this is where outliers like us save time, make money, and start winning with less risk together as a team. So go ahead and subscribe if you haven't already. And let's work on today's member highlight. I'm going to start changing this up a little bit because I have some ideas on how to make every video even better. All right, so for our member highlights, I really want to showcase the questions that you have. So over in our Discord, if you go over to the questions from you tab, I want you to start dropping your questions in there. I think that this is a great opportunity for us to do one-on-one education where everyone can benefit at the same time. So let's go through a few of these. So first one here. Bonjour, Chris. Thanks for your videos. I've been learning a lot. From my understanding, why is sitting on cash in a bear market instead of coming out and protecting your gains with trailing stops? Well, you can do both, right? For example, let's say that you're long PayPal, and then you had a trailing stop on the 50-day moving average, and it got tripped, and then it went back up, and then maybe it got tripped again down here, right? You would be long in the bear market until your trailing stop got hit, and then you'd be in cash, right? Let's do the same thing with Tesla. You could have a trailing stop on the 50-day or the 20 or the 10 or whatever, and once you get tripped, you'd be in cash, and then you don't have to stress all the way down. So you can actually do both. You can actually do both. And for me, that's what I would do. This is what I would do. If I had a trade on and it wasn't tripped on my trailing stop, I'd let it run as far as I can. And when it turns around, I would get out and look for new opportunities. And if the new opportunities don't come, that's okay too. That's okay too. Marky Mark, this is the smartest man I know. Putting this out there for whoever needs to hear it. DCA on the way down is dumb. You're just paying for someone else's exit. Dollar cost averaging on the way back up at semi-regular intervals into diverse holdings if you want to be lazy about it. That's what he's saying. That's what's to do. Christopher, you talk as if you're not paying any capital gains on any moves that you make. Respectfully, how do you get in and out so often without going long-term and not being overtaxed on your sales? So this is a good question. And it's one that I hear a lot, right? How can you say, close your stock, right? But I'm a long-term investor. I want to hold this as long as I possibly can because I don't want to pay taxes on it. Let's give some perspective here. You're only paying taxes on your gains. So for example, if you bought Tesla at, let's say you bought it right here at 269, and Tesla goes up and up and up, and you get this red light right here, and you get out. Right there, right? You made $156 a share. That is baller. That is awesome. I would love to make $156 a share. But if you said, no, I'm not going to hold it for tax reasons, right? Or I'm not going to sell for tax reasons. You're not paying tax on everything. You're only paying tax on your gains. So to watch it come back down, which a lot of people did, it round tripped this entire move, $156 up, $156 down, just in this one example. To say I didn't want to sell because of tax, right? When are you ever going to sell? If you aren't going to go up, ride the wave, ride the trend, and get out the top, what are you even doing? Are you just planning to hold it for ages so you don't have to pay tax on it? Bro, if you're going to hold something that has market risk on it, and you're not taking advantage of the market's opportunities that are presenting itself to you, what are you even doing in this game? You're only going to pay tax on the gains that you make. I consider myself highly, highly blessed. If I can pay taxes, that means I've made hella dollars. And I want to pay as much taxes as I possibly can on my capital gains because that means my account has grown tremendously. Now, you could do it in an IRA account. You could do it in a 401k account. You could do it in a tax advantaged account of any kind and then pay taxes later on. That's a great strategy as well. But it's like wanting to get a promotion at work, getting that promotion and then saying, you know what, I would love to make money, but no, thank you. That means I have to pay more in taxes. Nah, I don't want that promotion. That's equivalent here, right? So be smart about this. If you are paying taxes, that means you're making money. And I'm okay with making money. I hope you are too. In fact, I wrote a reply. I want to pay as much taxes as possible on my trades. That's a byproduct of making tons of money. I'd rather pay taxes on gains than not pay taxes on a losing trade, wouldn't you? Let's go to this one here. DCA is not your friend. One, if you invested it all in at the top. Number two, you don't have loads of money just lying around to top up on the way down. And number three, the stock never ever recovers. DCA is overrated and quite risky. Right, exactly. For example, let's just say that this was your 401k. You chose the wrong investment in your 401k, and that I'm sure has happened to a lot of people, and that sucks. But I'm not saying your 401k is empty. I'm just using this as an example. If this is going down, do you actually think that dollar cost averaging into this is a great strategy all the way down? Imagine 20 years from now, you open this up and you look at it and you're like, I've been investing for 20 years. This is going to be great. And you're like, wait a minute. Where'd all my money go? I dollar cost averaged all the way. Dollar cost averaging on the way up is the only way that this works, because you know where this is going. Because only price pays. And you can dollar cost average the mess out of this. But it doesn't mean you're going to get paid. Let's do a couple more. This is a long one here. The thing that you don't realize is that with this valuation, AMD cannot go much lower. Oh, that's brutal. I don't know when this screenshot was taken, but I can bet you it's gone lower since that point. The thing that you don't realize is that with this valuation, AMD cannot go much lower. Simply cannot. Oh my gosh. Because the business makes good money, beats earnings, and at $200, it was overvalued because investors thought that AMD can capitalize big on the data center things, which they couldn't. So the stock is down, but it's at a fair value for it. The business otherwise produces good numbers. 4 PE ratio is pretty low as well. It can go 90 to 100 worst case, but your commentary is saying that it can't go down another 50% is just unrealistic, simply because the company is worth way more. The don't buy a falling knife commentary also just makes no sense. Listen, clearly this person has not been educated in how the market works, right? The market has cycles. The market has cycles. Here, you've got your stage one down at the bottom. Your stage two is when it's moving up. This is when you want to be dollar cost averaging into things. Why? Because you're getting paid as it's going up. Stage three is the top, and stage three is frustrating, right? Because you're getting in thinking, oh, it's going to continue on, and then it doesn't, and then the moving averages cross, and it's just, this trade just isn't going to work out. And then a lot of people are here on stage four, anxiety, denial, and panic, which I could read all three of those in that particular comment there. And they're like, it has to go back up. It can't go lower than this, right? It simply cannot go lower. I'm sorry to tell you this. I'm sorry to tell you this. The market can stay irrational much longer than you can stay solvent. And for you to assign a value on what a stock should do, which is the most dangerous thing you could do in finance. The most dangerous word in finance is should, because you emotionally tie yourself to an outcome that may never happen. So yeah, I am definitely pissing off the long-term bros. And that's okay. That's okay. Let's go with another one of these real quick. And like I say, I want to start reading these questions from you. So go in our Discord, hit the questions from you, and just drop your questions, right? I want to make these YouTube videos better than most people's paid courses. This person says, I don't understand. If you lose 50%, then gain the 50% right back. Aren't you exactly where you started? Ooh, this is a juicy one. This is a juicy one here. And a lot of people get this confused, and I understand why. A 50% loss requires a 100% gain to get back to even. This breaks a lot of people's brains. A 50% loss requires a 100% gain to get back to even. What does that even mean? What do you mean, Chris? That's not a thing. Shut up, Chris. You don't know what you're talking about. You're losing your hair. You wear glasses. You got a big nose. Shut up. Nah, let's do some math here. Let's do some math here. Let's say Palantir, just for examples. Let's say Palantir at $100 went down to 50. Right? That would be a 50% loss. Now, to get back to that same $100, it wouldn't be a 50% gain. In fact, that would get you back to about 75. You would need a 100% gain. You need the stock price to double from 100 down to 50 is a 50% move. But to go from 50 up to 100 is a 100% move. That breaks a lot of people's brains. And this is how losses work against you so much more than winners do. Right? Because you need twice the size of a winner to make up for the same loss right there. It's crazy, 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 crazy. But that's how math works, unfortunately. So I want you guys to please drop your comments in the chat, or I should say in the Discord, because we're going to make this the very best place on YouTube for all the traders, all the investors out there. So here we go. Be sure to share your stories and questions in the Discord. And the first rule of Outlier is you tell everyone about Outlier. If this is useful to you at all, I really want you to go tell other people to join in live, to join in on the replays, whatever, right? They don't have to subscribe to Outlier, but they do need to subscribe to our channels. All right. So hit the like button. So that tells YouTube that you love this as well. Now back to trading in the Outlier trading room. What is Outlier and how does it work? Well, old Uncle Warren used to say, be fearful when others are greedy and greedy when others are fearful. Outlier shows you if investors are acting rationally fearful or greedy and by how much, allowing you to get into the stock before the Outlier move happens. And if you're ready to save time, make money, start with less risk, head on over to outlier.com and get the annual pass for just 82 cents a day. And if you are a monthly member, we've now made it super easy. It's a one-click upgrade to save 64%. Not too shabby. So my style of trading using Outlier is called the golden ticket trading strategy, and it's where only price pays. Now I want to see the 10 under the 20, price under the 50 if I'm going short on the SPY. So let's go over there. That's exactly what we see here. The 10, the blue line, is under the 20, and the price is under the 50. Our Outlier trend template shows us that the market is bearish right now. Just plain fact. It is math. The math is mathing. Okay, the math is mathing because the short-term trend is down, the intermediate-term trend is down, and the long-term trend is down. So which direction is it going? Say it with me. Down. Even a 9-year-old could understand trend following, right? But most people don't understand this because they want to be the ones who catch the bottoms. They want to be the ones who catch the tops. And they don't realize the money is made in the 80% between the top and the bottom. So the market is absolutely bearish. Let's look at market breadth. Market breadth actually may have peaked. I was looking at this earlier today. So inside of Outlier, what this measures is how many stocks have buy signals versus sell signals. So the green line measures the amount of buy signals that we have. And it actually looks like it's flatlined. Yeah, it was at 63.78 yesterday. Today's at 63.60. So this may have peaked. And then I throw a 10 EMA with that. And I look for these crossover points here. So this is still technically bullish. But if this does cross down, I'm ready to get right back in for some shorts. Because the master key still has a sell on the SPY signal, which could change soon. The market trend is still down. Market breadth is currently bullish, but it looks like it also may be changing as well. So yeah, say it with me, Jim, down. So there may be some shorting opportunities to come up with, but for me, I don't see anything just yet. And that's okay. There's no trade setups for me today. I got no more FOMO. But what are you looking at? Put your stocks in the chat. I want to look at some of the stocks you're looking at today. Now, when you put those in the chat, be sure to put in the name of the stock and long or the name of the stock and short. So put those in the chat and let's get busy looking at your stocks. Dave says he is too tall to short. Oh, free computer training. Long, Rivian Long. All right. Let's look at Rivian Long. I'm not sure if we have Rivian in here. We cover 2,500 stocks, adding new ones all the time. Is it RIVN, I believe? No, we don't cover Rivian, but that's okay. I can still look at it on the chart for you. We cover 2,500 stocks, adding more all the time. We just need additional data points on those stocks that we don't cover yet. So there, it's growing by the day. Check it out. You do have the 10 over the 20, price over the 50. That's a great place. You do have this big, strong green bar right here. And in fact, we were watching a Felix video this morning talking about how important the volume is. That's what you want to see. You've got volume that's super high. You have a big green candle right here. This is what you want to see. Let's look at a different, let's look at Ford. Not to say Ford and Rivian are equivalent, but what I want to see is the sector. All right, so the sector, the discretionary sector, is getting less fearful. Less fearful. That's what I wanted to see down there. So for me, Rivian looks pretty brilliant, honestly. I like this one. I like the stock. Your 10, 20, 50, all looks good. RJ, what time are your 2 live streams? So first one is in the morning, 7:45 Central Time after I drop my son off from school. Second one is the last hour of the trading day, so from 2 to 3 p.m. Central Time. And I'm glad you made it, my friend RJ. Glad you're here, my friend. Let's look. Philip. Let's look at Twilio, TTLO, TTWO. Oh, Take-Two Interactive. That's not Twilio. All right. So look at this huge. Man, I got to tell you, when you see the greed get ultra high like this, look for snapbacks. And then you can see the greed really sold off hard. It didn't even go down all that much, and people started losing all their greed out of it. It's currently with an active sell signal, so we wouldn't be looking long on this one here inside of Outlier. But looking at it here, it's getting a little bit more greedy. The communication sector is getting less fearful, starting to look more greedy. Let's look over here on the chart, see if anything else pops up. I mean, this one doesn't look bad to me, right? You've got 10, 20, 50, no order blocks in the way. But always keep in mind, for all of your stocks, 40% of the move is due to the market. So if the market's weak, your stock could be doing even better if the market were strong. 30% is due to the sector, and only the last 30% of the stock's move is due to the stock itself. So if the sector were strong, like XLC, if the sector were strong, which is not all that strong, if the market were strong, which is definitely not strong, what's this? Take-Two Interactive could be a giant baller. But as of right now, it looks good. Just keep your risk in check. X short. That's not Elon Musk's X. That's US Steel. I remember seeing this one time and being like, why in the wild world of sports is X for US Steel? Superfly. Superfly. Look at this. We got a buy signal coming through here. We can see the stock is getting more greedy. That's what you want to see. You combine an uptrend with the green overlay, with the buy signal, with the stock getting more greedy. That's what I want to see. And then the sector itself losing fear, moving towards greed. I like X. Let's look over here real quick if there's any order blocks in your way. Soon to be called outlier blocks. You got one up here at 47. Man, X was a $10 stock the last time I looked at it. You got about 8% before you get run into an order block. So I like this one. This is actually a great one. Mofo. Let's look at Dollar General. DG. Dollar General. Buy signal. Getting more greedy in an uptrend. The sector, however, staple sector, not quite as greedy as it used to be, but so far so good. I mean, the only thing working against it here is the sector. Oh, couple order blocks right here. It's 304, so it didn't quite close on the opposite end of this. This order block will go away by tomorrow morning. This order block looks like it's still going to stay. If it can push through here up to like 88 or so, this could be awesome. Could be awesome. I appreciate that. Jonathan wants to look at Gilead. Sell signal. Look how greedy this got. And then the sell signal came up to 90. Sell signal came through here. We got the sector getting a bit less fearful. The stock itself getting less greedy. He's looking at Gilead long. I don't love it from a long perspective. I don't love it from a long perspective. I do like that it bounced off that 50 moving average right there, though. So, yeah, just keep your risk in check right there. It's coming back. It is coming back. Just keep your risk in check. So, listen. If you are an influencer of any size and any niche, we want to work with you. Shoot us an email over at support@outlier.com and be sure you come back tomorrow morning where outliers like us will save time, make money, and start winning less risk together as a team. Now, YouTube is going to pop up a couple recommended videos. Listen, I recommend you watch one of those. I recommend you have a fantastic afternoon. We'll talk soon.